Welcome back to How to Become a Real Estate Developer, Lesson 3. This is one of my favorite lessons because we're going to talk about finance. We're going to talk about how to secure financing for your project or for the project of one of your clients. We're also going to talk about the types of financing that are available and how you can leverage and understand loan structures as well as working with investors for your projects. You'll be able to embark upon a journey of seeing all the different ways you can finance a project. So let's get started. Now, when you're developing a project for yourself or for your clients, what you want to do is really understand all of the financing options available. Now, if you have a client or you yourself are independently wealthy or are able to finance your entire project, then maybe this section is not for you. However, if you're like most people, you need to stack some resources together so that you can be able to create your first development. So how do you do that? Well, there are many ways. For one, you can put in some of your own personal money. Next, you have an option to do a bank loan. Sometimes the bank loans, and this was a thing I didn't understand when I first started, sometimes the bank loans don't require as much as you might think they do upfront to be able to secure a loan. I used to think that you had to have all of your engineering plans done and all of your architectural plans done before you can apply for the bank loan, but that is just not the case. You still need to have some site feasibility work done and some basic engineering and some basic architectural, but you do not have to have all of your plans fully done before you start your loan application process for the bank. Now, if you're doing this for yourself or for a client, make sure before you apply for a bank loan that you have all of your paperwork intact, all of your taxes, W-2s, especially if you're applying for a loan over $1 million. Make sure you have your assets in place and you can show that you have some capital in reserve. You have money in the bank. If you do not have money in the bank, then you need to be creative on how you can get money in the bank, either by working with others, getting a professional to help you with securing some investors, or figuring out a way to pool your money with others. There are all kinds of ways to make that equity appear in your bank account legally. So make sure you are working with people who can help you. So bank loans. Bank loans can be anywhere from private banks to, or they're all private, but any kind of bank, institution, or credit union that will allow you to use some of their funds to be able to continue developing and do your acquisition and development. So you can do an A&D loan, or you can do a construction loan, and take care of the entire project. Either way, a bank is a great partner to have when you're on the development journey, because not only can they be a great resource for continuous funding, but they can also be a great backer for you when you're trying to leverage funds from one place to another or with another institution, such as a private equity fund. Another place is a private equity fund. A private equity fund is a group of investors who come together and they fund the work of development. So they fund different developments, and they do that by creating their own fund, and they pool their financial resources together. Private equity funds can get upwards of, multiple millions of dollars to the 100 millions to, I have one that, or have access to one that has $4 billion in it. That particular private equity fund, you go to, the person who is managing the applications, you apply, you submit all the criteria for your project, and they let you know what needs to change and what can get you to qualify for the funds that come out of that private equity fund. But that is available for anybody, regardless of your credit score, regardless of your assets, but they have specific criteria. You just have to find the one that works for you. And also understand with private equity funds, the interest rates may be a little bit higher, but they're also, the loans are a little bit different in terms of how you qualify for them. So it's a great tool to have when you're trying to help your clients find funding and find financing to be able to build their projects. Another one is any kind of subsidy. A subsidy is a substitution for funding. So it could be in the form of a tax credit, a grant, or some other pot of money that allows you to benefit financially from bringing the development to that particular area. Sometimes subsidies are handled through the city government, through the county government, through a local land trust, or through the tax office. They come in all shapes and sizes, but a subsidy can help you develop a project. Another thing to just be on the lookout for, regardless of any of these financial resources, are interest rates. When you get money that is a little bit easier to get, it also comes with higher interest rates. Money that's harder to get typically comes with lower interest rates. So keep that in mind. And then another act that you need to be aware of is the Community Reinvestment Act. This act allows banking institutions to hold money that can be lent to communities that are developing in communities of color or in under-resourced communities. It was signed into law by President LBJ, back in the 70s, I believe. And when it was signed into law, it allowed institutions to help secure funding for hard-to-develop areas across our nation. That Community Reinvestment Act is still authorized and is still very much in use by developers all over the nation. The only requirement is that you go to an institution that has the ability to lend CRA funds, and CRA funds typically come with a lower interest rate. So these are typical financing ways, or ways that you can finance a project. These types of financing include debt. I mentioned equity, bank loans, private and personal loans. Never underestimate the power of your pocket. If you can pay for something out of pocket, that is considered investing your own money. If your client can pay for their own engineering and architectural services, that is considered investing their own money. My first client who developed their project, they paid for a significant amount of things out of their own pocket, but from their business ventures. So it was a write-off, but it still was their own funding and their own finances. I mentioned private equity funds. Those are available. There are so many, so you have to do your research to know which ones are the best for you and for your project. Government programs for development. I mentioned land trusts. Community land trusts are interesting because they allow you to develop property and keep it in a safe space with deed restrictions that protect the affordability of the project over time. So that is a good way to develop property that, you want to remain affordable in communities, especially communities that are underrepresented or under-resourced. Okay. Another one is tax credits. So I mentioned this before. Tax credits allow you to essentially benefit financially from not paying as high of a tax rate on a particular property if you're developing it in an area where the city says, hey, we need development. We want the tax base, so we'll give you, the developer, the tax credit up front in exchange for the fact that, you're bringing this development to our city, to our area, and investing in our people, in our community. And then grants. There are grants galore for development. Sometimes they come in the form of affordability. They come from American Rescue Plan, the bipartisan infrastructure law that exists in our government, regardless of what side you represent. That is a law that is in place currently that does have through money that passes down from the federal government to the state government, to the local, and to community-based organizations who are looking to maintain affordability and develop infrastructure. So we talked about water and sewer and power and gas. All of those things are things that are needed for a community to thrive. So they come in the form of a grant or funding that people can use, groups, developers, et cetera, that can use to be able to support the development in that community. Now, when you are working on a development and you're trying to attract investors, it is very important that you adequately sell what it is that the investor is purchasing. So from a marketing perspective, they need to be able to see that, this is a great project. It looks great on paper. It doesn't always have to look great, but it should look great, so that the investor is enticed by the eyes to be able to make a move toward looking at this project seriously. The second thing that you need to attract an investor is a pro forma. An investor needs to see that the pro forma performs. In other words, the project is going to make money. No investor gets into a deal knowing that they're going to lose money. They get into deals thinking and hoping and confirming that they're going to make money. So make it possible for the investor to see how they're going to make money on your deal before they sign up to be an investor in your project. And then get help from a licensed security broker or a professional. Do not try to attract investors on your own and be accused of violating SEC practices. You should always work with a licensed securities professional when you're trying to do that, especially if you're committing a certain amount of returns to a particular investor. Now, what is a pro forma and what does it need to do to perform? A pro forma is essentially a spreadsheet of numbers, right? That spreadsheet tells the investor how much it's going to cost to build this project, what is the 5-year outlook or analysis on it, how much money is it going to make in 5 years, how much money is it going to make in 10 years, heck, how much money is it going to make in 1 year? And really, is it worth the investor's money to be able to tie into or invest into this project? To be clear, a bank is going to want to see a pro forma, just like an investor is going to want to see a pro forma. So my recommendation as a newer developer is that you get a person who knows how to produce a pro forma for you so that their expertise is shining and you're not trying to learn how to do this, because I promise you, you'll spend all year trying to learn how to do a pro forma if you try to do it yourself. Get a professional to do it. I have a person I work with. I found them on Upwork. I found the criteria that I needed to make sure I hired the right person, and that is the person I use. The spreadsheet is editable, but everything connects. All the formulas connect across the tabs on the bottom, and it has all of these categories in it. Cover sheet, the development costs, the debt structure, operating expenses or anticipated operating expenses, year one ramp up, the 10-year pro forma, how well is the project going to do over the next 10 years, a sensitivity analysis, and then the final analysis. A bank is looking for a DSCR rate of 1.25 or better. And many times it's or better. So you want an experienced person who knows how to write or how to do and prepare a pro forma doing it, not you, unless you have experience in this area. So I will tell you right now, I won't be doing pro formas anytime soon. I will hire professionals who can do that work and who shine in that area. So get yourself a pro forma, but this is what a pro forma is. Okay. And so once you get yourself a pro forma and you understand what it is, it's going to be crucial to use this to present to any financial institution as you go and seek out the funding and the financing for your first project. And that concludes lesson 3.